Most people spend their entire adult life depending on one machine. Their job, as long as they show up, the machine pays them. The day they stop showing up, the machine stops paying. That arrangement feels normal because it is common. It is also far more fragile than most people want to admit. If you want to stop working without watching your lifestyle collapse, you need to do something most workers never learn to do. You need to build your own private payroll. That is how I think about it. Not retirement as an age, not freedom as a slogan. A private payroll, if your job pays you $80,000 a year, then the real question is not whether you feel tired of the office. The real question is whether you have built a group of assets capable of sending $80,000 a year back to you without asking you to clock in on Monday morning. Once you understand the game that way, your entire investment strategy changes. You stop asking only what might go up. You start asking what can send cash back to me again and again, whether I am working or not. Now, I want to be very honest with you before we go any further. This is not easy. It is not quick. It is not something you fix with one lucky stock tip, one crypto trade, one weekend course, or one fantasy about passive income while you are lying on a beach pretending that hard things are easy. To replace a paycheck, you need capital, discipline, patience, and in many cases, a willingness to do real work before the income becomes steady enough to matter. But I have also lived long enough to know that the people who understand this early stop thinking like employees first and start thinking like owners. That identity shift changes everything. I think about these assets as 5 income engines. The first is the simplest, the last is the most demanding. And the mistake most people make is assuming that because the first one is simple, it must be bad, or because it must be glamorous. Both ideas are foolish. Good investing is not about glamour. It is about function. So let us start with the plainest engine of them all. If you lend money to the United States government, the government pays you interest for the use of your money. That is what Treasury bills and Treasury bonds are. You are not buying growth. You are buying income backed by the strongest tax base in the country, and, if we are being honest, backed by a government that has every incentive to keep rolling its debts, because the alternative would create problems far larger than your little portfolio. This is why I think of Treasuries as the training wheels of income investing. They teach you the basic lesson. Money can be deployed and come back to you on a schedule. That lesson matters. A great many people keep their cash in places where the number feels safe, but the purchasing power quietly rots. At least with Treasuries, you are making the money report back to you. The drawback is obvious. The principal does not compound through business growth. If you invest $100,000 and the yield is roughly 4 or 5%, you are collecting interest on $100,000. The machine does not suddenly become a thriving enterprise. It remains alone. The ceiling is built into the structure. That is why I would never confuse a Treasury engine with a wealth engine. A Treasury engine is an income stabilizer. It can give you monthly or regular cash flow. It can reduce anxiety. It can create a floor under your financial life. It can serve people who want predictable cash without a lot of drama. But it will not turn a modest nest egg into a fortune unless the nest egg is already large. That leads us naturally to the second engine, businesses that make real profits and share a portion of those profits with owners. This is where dividend paying companies enter the picture. If I own a piece of a business that earns more cash than it needs and sends part of that cash out to shareholders, that business is beginning to act like a paycheck machine. Not because it is magical, because it is profitable. The problem is that most people are not good enough at business analysis to confidently pick one dividend stock after another for the next 20 years. They fall in love with a name. They get hypnotized by a high yield. They ignore balance sheet problems. They notice the dividend and miss the rot. That is how people end up buying a company for its income, only to discover later that both the stock and the payout were weaker than they looked. That is why the simpler route for most people is a basket, a dividend ETF. Instead of depending on one company, you own a collection. Some focus on dividend aristocrats, businesses that have raised payouts for decades. Some focus more broadly on high-quality American dividend payers. Some go overseas and give you exposure to foreign companies that throw off attractive cash yields. The advantage is obvious. You spread the company-specific risk. One management team can become foolish and the basket survives. One company can stumble and the fund replaces it over time. This is much more sensible for people who want income without turning their evenings into a full-time forensic accounting hobby. But I want you to hear me very clearly here. A high dividend is not the same thing as a good investment. Yield can be bait. If the asset underneath is weak, the income stream becomes a trap. People love to chase the biggest percentage they can find because it lets them fantasize about replacing their job faster. Usually that is greed trying to sound efficient. I would rather own a lower current yield from a stronger basket than a flashy payout from something that is quietly falling apart. You should always ask one question before you get excited about the income. What is producing it? That same question becomes even more important when we step into real estate. Now, we are no longer talking about lending to the government or owning a basket of public companies. We are talking about buying a hard asset that can produce rent. Real estate is one of the greatest wealth building tools ever created for people who are willing to treat it like a business instead of a fantasy. It can do three beautiful things at the same time. It can put cash in your pocket. It can give you ownership of something tangible. And if you understand the tax code, it can let you keep more of what you earn. That combination is why so many wealthy people end up there. If I buy a property correctly, the rent pays the taxes, insurance, maintenance, management, vacancy allowance, and still leaves me with money. That leftover money is not theoretical. It is the start of a private paycheck. Then, while I am collecting that cash flow, the property may appreciate over time, the debt may be paid down, if I used financing, and the tax code may allow depreciation and other deductions that reduce the amount of income I actually have to hand over to the government. That is a very powerful machine, but people romanticize real estate because they see the payoff without respecting the labor. Deals are not hanging from trees waiting to be picked by lazy people. You have to know your market. You have to know your numbers. You have to know what kind of cash on cash return actually justifies the headache. You have to assume repairs. You have to assume vacancies. You have to assume tenants can disappoint you. You have to decide whether to buy all cash, use sensible leverage, or partner with capital. And above all, you have to refuse the most dangerous phrase in business. How hard could it be? That sentence has bankrupted more optimists than recessions have. Real estate is wonderful for people who are willing to become serious. It is miserable for people who want the story without the structure. That is why I always tell people to pay themselves for management, even if they are doing the work. If your deal only works because you pretend your labor is free, then your deal is weaker than it looks. Better to underwrite honestly and sleep well than flatter yourself with fake returns. Then we reach the fourth engine, ownership of an actual operating business. This is where things get very real very quickly. There is a profound difference between earning a salary from a company and owning the profits of a company. Employees receive compensation. Owners receive what is left after the bills are paid correctly and consistently. That difference is the entire ladder between labor and capital. If a business brings in $1 million, spends $600,000 operating it, and keeps $400,000 in profit, that remaining profit belongs to the owner class. If you are in that class, your financial life changes. You are no longer simply renting out your time. You are controlling the machine that converts effort, systems, staff, and capital into distributable cash. That can be life-changing. It can also be brutal. You can start your own business, which is the hardest clean room version of this idea. Or you can buy an existing business, which sounds easier on the internet than it usually is in the real world. Either way, I want you to understand the actual rule. Small businesses often look passive from a distance and deeply active from up close. In many cases, if you do not work in the business weakens. Truly passive ownership generally requires either exceptional management already in place or enough capital to buy a machine that runs without your Most people underestimate how much money and skill that takes. That does not mean you should avoid business ownership. It means you should respect it. A good business can become a far better paycheck replacement engine than almost any financial asset on this list, because the profit can grow, systems can scale, and value can compound beyond the immediate income stream. But if you are not willing to learn the industry, understand the economics, and solve problems when they appear, then the business will humble you very quickly. This is why I always tell people to choose an area where they can either work with conviction or learn with conviction. Passion alone is not enough. You need operational competence. The world is full of people who bought laundromats, car washes, agencies, restaurants, or small service businesses because someone online told them it was simple. Then reality arrived with payroll, broken equipment, customer complaints, rent increases, taxes, compliance, and staff turnover. The machine only becomes a paycheck machine after you build or stabilize it. Before that, it is a problem-solving machine. Still, for the right person, nothing on this list creates the owner mindset faster. And that brings me to the fifth engine, which is perhaps the least familiar to ordinary people, and one of the easiest to misunderstand: private credit. This is where you become the lender. Instead of putting money in a treasury and lending to the government, you lend to individuals, operators, real estate investors, or small businesses. In exchange, they pay you interest. Sometimes that interest is very attractive: 5%, 10%, 15%. Occasionally more. When people first hear those numbers, their eyes light up. That is usually when they stop thinking, which is dangerous. High interest is not a gift. It is a signal. If someone is willing to pay you 10 or 15% for money, they either have a high return, a weak set of alternatives, or a risk profile that conventional lenders dislike. Sometimes it is legitimate, such as a real estate operator using short-term capital for a profitable renovation. Sometimes it is a warning label wearing cologne. That is why collateral matters. If I ever lend privately, I want to know exactly what stands behind my capital if the borrower stops paying. I want paperwork. I want security. I want a clean claim. I want an explanation for why traditional financing is not being used or not being used in full. I want to know the exit. I want to know what has to go right for me to get paid and what still protects me if things go wrong. Otherwise, I am not investing. I am hoping, and hope is not an asset class. Now, when you zoom out, you begin to see the larger architecture. Treasuries are the conservative income floor. Dividend ETFs are the liquid public busyness cash flow sleeve. Real estate is the hard asset tax, efficient cash flow machine. Business ownership is the high effort high. Upside owner engine, private credit, is the lender engine, where yield rises with the need for caution. The reason I like thinking about them this way is that it stops people from asking the childish question, which one is best? That is not the right question. The right question is, which combination fits your stage, your temperament, your capital, your skill, and your tolerance for work? A school teacher near retirement with a large nest egg and no appetite for tenants may prefer more Treasuries and dividend funds. A hungry 40-year-old with operational talent may get richer through business acquisition than through any ETF on earth. A patient person with local market knowledge may build a far better paycheck machine through disciplined rental property investing than through stocks. A sophisticated lender with iron underwriting discipline may do very well in private credit. The point is not to copy somebody else's machine. The point is to build your own. But there are 3 rules I would insist on no matter which engine you choose. First, never confuse income with safety. A 10% payout from a weak asset is not better than a 4% payout from a strong one. Bad principle destroys good income plans. Second, never confuse simplicity with inferiority. Some people mock Treasuries because they are plain. I like plain when plain works. The job of an income floor is not to entertain you, it is to hold the floor. Third, never confuse ownership with passivity. Real estate is not passive unless the system is built. A business is not passive unless management is built. Private credit is not passive unless underwriting and servicing are built. Passive income is often just active design that happened earlier. The real transformation here is psychological. When you live off one paycheck, you think like a worker. When you build assets that pay you, you begin to think like a capital allocator. You start asking different questions. How much principal does this engine need? What is the durability of the cash flow? What is the tax treatment? What happens in a recession? What happens if rates fall? What happens if tenants disappear? What happens if management fails? What happens if a borrower defaults? What happens if one engine slows down and another has to carry more of the load? That is how wealthy people think. Not because they were born knowing it, because at some point they stopped worshiping income from labor as the only respectable form of income. I have no problem with work. I admire work. But I admire systems even more, because systems keep paying when your back hurts, when your energy fades, when you want more time with your family, when you want freedom to say no, and when you finally decide that enough years have been spent trading time for money. That is the final destination, not quitting work because you hate effort. Quitting dependency on one paycheck because you have built something stronger. A private payroll. That is what these 5 assets really are when used correctly. Not magic tickets, not shortcuts. 5 different ways to train your capital to report back to you. The people who never get there usually make the same mistake. They wait for one giant move, one perfect investment, one dramatic breakthrough. Real life does not work that way. Most of the time, financial freedom is built the same way. A brick wall is built. One layer, then another, a treasury sleeve, a dividend sleeve. One property, then another, a business. Then systems, a lending discipline, then a cash stream. Slowly, the random job paycheck stops being the whole structure and becomes only one line item in a much bigger one. That is when your life changes. Not when your salary rises a little. When your money begins to work a second shift after you stop. If you understand that, you are already thinking differently from most people. And that difference, over 10 or 20 years, is often the difference between asking for permission to stop working and quietly realizing one day that you no longer need anyone's permission at all.